All right, it's that time of the month. No, not that time of the month, but it's expiration and rollover time for the futures. I'm going to talk a little bit today about how this works, how it looks, and if you've never traded it, why you shouldn't be afraid of it. It's pretty simple. Every contract has a time expiration component, whether it's financials, S&P, Dow, Russell, NASDAQ. And if you're just starting your business, these are probably the prime trading vehicles you're going to use. And then they happen to expire 4 times a year. It's each quarter: March, June, September, and December. So today happens to be June 9th, and we're getting close to, or rather we're beginning the process that is called rollover, and expiration is completed by next Friday. So let me just tell you right now, you may not be a pro, but don't trade like an amateur, which means starting today and tomorrow, really the best time to roll over your position if it's a position you're going to hold when there's less gyrations because of this process, okay? So here's the way it works. Contract month is the month in which futures contracts expire. All the E-mini stock index futures trade on the quarterly expiration cycle, so that's March, June, September, and December, as we talked about. March works out in the futures listing as H, so and then June is M, September is U, and December is Z, as in Z. So if you are currently involved in the June, you would be trading the M contract, and that is rolling over to the U, which is the September contract. And the September contract will happen and roll over in September. Okay, so the ticker symbol then is designated, if you were trading the S&P, it's ES for the S&P, M as in Mary for the month, which is June contract. And again, we are in the second week of June when rollover begins. The third week is when it is finalized. So you've got a process that starts happening today where most of the volume starts moving over from the M to the U. So it would read, if you're putting in a trade, and most systems will have this for you and tell you how many days until expiration, whether it's oil, whether it's wheat, corn, etc. And you need to know these. If you don't know these dates and the expirations, things like barrels of oil can show up if you're not maintaining and managing the rollover process. And definitely don't want to have to sell oil that has been shipped to your house in the aftermarket. Won't work out well. So now they can't ship a futures contract, but you still want, as far as the financials, but you still want to make sure that they roll over. So the E-mini contracts are similar to any other futures contract. They have a defined length, in this case usually around 90 days. They expire at the same time and same price as their larger counterparts. So the S&P, the full contract is the same as the ES, the same as far as the dates, and you just need to be aware of that. So the final settlement price of the contract is also determined at the end of the day that it stops trading, which is next Friday. So expiration, again, for the E-minis, ES, NQ, YM, TF occurs at 9:30 a.m. Eastern on the third Friday. So that's next Friday. If you're not out, you need to be out by next Thursday's close. Okay, so Thursday is when the amateurs close next, or roll over their positions. There's no reason for you to be doing that Thursday. Start doing it quietly. If you have one contract, it's easy. If you have multiple contracts, it's not that hard. You could have hundreds, and it's not hard to push a button and just say roll over my position. So if I was short the front month, I would buy the front month and then sell the new month. Okay, so that's pretty simple to do. So it occurs today, happens to be that Thursday, the 9th of June. So it begins today. This is the second Thursday of June, and the rollover starts on Friday and is finalized by next Thursday at the close. So you've really got a full week to get this done. The previous contract continues to trade until expiration, but the volume goes like this, down. So don't get caught being squeezed, at the mercy of whoever is left, right? The illiquidity kills you. So get the positions moved over, if it's a position you plan on holding, well before a day or two. That's when the amateurs do that. And so that's where I say, don't be an amateur, trade like a professional. So that's why we're doing these videos. So many active traders will trade the old contract on rollover day and then switch to the new one, say at the end of the day. Whatever works for you, because there's a difference in pricing. I was looking at the NASDAQ earlier. It was like 4,500 versus 4,515 on the current front. All right, so there's a difference that will pinch together as we finalize this process in the next week. The continuous contract is a combination pricing that the various delivery months put together also that you probably see. So if you type into Thinkorswim, for example, it's /NQ. That is the continuous price. That price will come together and will be the price that we're trading next Friday on the new U contract. So that's about it. That's an opener. Don't get caught. Know your dates, whether it's oil. And by the way, oil, wheat, corn, natural gas, they all have a different cycle. Very different than the financials. Bonds and the financials are trade quarterly. They're really simple. The others, I have to remember, they're changing all the time. Also, they change the contract expirations. You want to know what the margin requirements are. You want to know, when they stop trading. If they go up 5%, we'll do another video on that, on stoppage of trade. So that's it. Have a great Thursday afternoon. We'll talk soon.